You wrote a column toward the end of the week, really redirecting investors' attention back to the difference between liquidity on the one hand and solvency on the other. That's always important, but why is it particularly important right now?
Well, it's particularly important right now because we have had this extraordinary disconnect between the economy and the stock market, where we've had a string of absolutely dreadful news, 4.8% contraction in the first quarter. You have analysts predicting that peak to trough, you're going to have a 12% decline in GDP in the first half of the year in America, dreadful numbers out of Europe, and yet the stock market have rallied, although they did come back quite significantly on Friday. And one way to make sense of that is a lot of investors, when you speak to them about why they're so optimistic, if they are optimistic, they say, well, it's because the Fed is backstopping everything. You know, think about that $5 trillion worth of asset purchases we've had from the large central banks, half of which comes from the Fed. The issue at stake is, as I wrote in my column, that can help address a liquidity crisis, a credit crisis. What it cannot do is address a solvency crisis where you have a bunch of companies and consumers who simply have too much debt to ever repay out of their revenues, which are now collapsing. And although we primarily had a liquidity crisis in the first stage of the COVID-19 shock, we could now be morphing into a solvency crisis if this problem continues, if the lockdowns continue, if we don't have a rapid medical miracle. And that is something that the Fed cannot deal with, nor in many ways can the Treasury.
Exactly. The central banks can tend to deal with liquidity. It's harder in solvency. At the same time, did we see some evidence this week of maybe some sectors that are benefited actually on the fundamentals? We saw some tech numbers that came in very, very strong. Healthcare also seems to be doing well as opposed to some other sectors.
Absolutely. Right now, it really is all about tech and healthcare, and those are the sectors driving things upwards, which is quite understandable because we are seeing this extraordinary dash towards essentially people adopting technology on a scale and degree that we never think was going to be possible. We had Microsoft coming out and saying essentially tech adoption had been accelerated by 2 years compared to what they'd been expecting. And at the same time, obviously, healthcare stocks are doing a lot better. We've also seen a lot of consumer goods stocks doing quite well, too. That's quite striking. And on top of that, we've had problems, entirely expected problems developing in the airlines, in retail and sectors like that. So it really is
even there, Stephanie, it strikes
a tale of two cities, if you like.
Sorry,
very
go ahead.
Contrast. It's a tale of two cities, very stark contrast between some sectors doing better than others. And that's going to be the story increasingly in the months ahead.
Stephanie, it strikes me that one of the things that's important is we're starting a new month now. Rent comes due on May 1. Where are we with the real estate market?
Well, that is a huge question because Friday is truly a critical issue, the 1st of May, because we saw already a lot of non-payments for April. And the problem with that is that starts to create a cascading domino effect along the whole chain of obligations that essentially normally make capitalism work. And if May is going to be worse than April, which is what everyone is expecting, I'm hearing stories from some bankruptcy lawyers that maybe half of all rents will not get paid in major urban centers, then that's for the commercial real estate sector. Then essentially that's going to put enormous pressure on commercial real estate companies. We've had people like Tom Barrack from Colony, which is basically one of the big commercial real estate players, essentially saying that there could be huge problems coming down the road. And that's a kind of chain reaction that starts to really put solvency on the map for investors and for policymakers. Because the other thing to realize is when you have a crisis of this magnitude, if you have a sudden shock decline in GDP, you don't have companies going bankrupt immediately because, you know, they often have a bit of money to keep themselves going with. It really takes a rolling process of the problems going down the chains of debt, down the payment chains for the pressures to start to emerge. And that's why essentially the 1st of May is so critical, because if those rent payments are not paid, that's just one more sign that we're starting to slide towards that kind of chain reaction.
And as you say, there's a limit to what the central bank can do about that problem.
Well, unless they are going to go and basically either implement a complete debt freeze, a debt jubilee, and you are hearing discussion about that. You are hearing people say that should be the case in the consumers as well, because there's another set of problems brewing in the whole mortgage market on the retail side, and questions about whether essentially wholesalers are going to pay mortgages, whether they're going to be given a moratorium, what that would mean for the whole mortgage market going forward. But essentially, if you do start to see these essentially non-payments developing, either the government steps in and says, okay, we're going to freeze everything, or the lenders do, or you start to get a lot of defaults, and that's a mess.